What's up, everybody? Welcome to the newest episode of Demo Day, the podcast for entrepreneurs and venture capitalists, where we demystify the culture of joining one of the top accelerator, incubator, or VC programs from around the world. I'm your host, Sean Goldman, CEO of Coefficient Labs, and on today's show, we'll be interviewing Kareem Aly, principal at Thomvest Ventures, former investment banking analyst at Deutsche Bank, and a current member of the VC fund at UCLA. At Thomvest Ventures, Kareem focuses on cybersecurity and cloud computing and has already seen 2 of his investments get acquired by BlackBerry and McAfee. Kareem discusses how to rise up when you're the new hire at a venture capital fund, the importance of continuously educating yourself, and his point of view on GYMS 3.0. Also, Coefficient Labs is giving away a $10,000 growth hacking package for one VC and one founder that leaves a rating and a review on the Apple Podcast. So if you're listening to this on podcast or watching it on our website, go check out the Apple Podcast, leave us a review, and you have a chance at winning. Without further ado, let's get into Demo Day. Kareem, thanks so much for joining us on today's episode of Demo Day.
Yeah, thanks for having me.
You're very welcome. So, Kareem, in today's day and age, the names of the venture capital funds, Upfront Ventures, 500 Startups, Andreessen Horowitz, there's so many VC funds that you hear in the press, but sometimes startups can overlook some of the VC funds that aren't always in the press as much or aren't focused on their PR as much. I wanted this episode to be an opportunity for startups that maybe haven't heard of Thomvest before to get to know yourself and learn a bit more about a VC fund that maybe they haven't heard of. And I think this is a great opportunity for us to do that.
Yeah, absolutely. I'm happy to give a little bit of background on Thomvest. So Thomvest Ventures, $300 million VC fund based in San Francisco. We used to be down the peninsula up in the Bay Area, and we just moved to South Park. So South Park in San Francisco is kind of the new Sand Hill Road, so to speak. A lot of VCs surrounding that park now. So $300 million fund. The name Thomvest comes from Peter Thompson. So he and his family own the majority of Thomson Reuters. We're not a corporate VC. We're not affiliated with Thomson Reuters at all, but it's solely Peter's capital. So one LP, we don't have to fundraise, and we're long-term partners in that way as well. We're pretty verticalized now, so we have a team that does a lot of fintech. So Don Butler and the team there, they were investors in Lending Club, SoFi, we're on the board of Cabbage, which is a unicorn. And then I myself partner with a partner on the team, Umesh Padval, and he was at Bessemer for 9 years, past CEO of a public company before that, sold it. And we cover a lot of cybersecurity and cloud infrastructure. So a couple of our recent exits last year, actually, we had 3 in security. We sold Cylance to BlackBerry for $1.4 billion. We sold Skyhigh to McAfee, where we had a board seat as well. And then we sold Skyport Systems to Cisco. And then we have a pretty large current portfolio as well.
That's amazing, and we're going to spend more time later on going into some of these portfolios that you're excited about and other elements of Thomvest. I think for the viewers here or listeners, for those listening on the podcast that maybe have never heard of you before, Kareem, why don't you tell us a little bit about your background? Interesting side note, guys, and we'll talk a little bit about this. Before Kareem was at Thomvest, sorry, my bad. Before Kareem was at Thomvest, he was at Deutsche Bank, and when he was 23, 24 years old, was actually involved in helping manage and oversee and advise Dell in I think it was a $63 billion acquisition.
Yep.
So Kareem is someone for anyone that's an early, student in finance and economics. I was thinking too, it would be a really great opportunity to talk to maybe some students that are thinking about going into the banking world or the venture capital world, and we can get a little bit more about that. Tell us about what was early life like for you? Where'd you grow up? What was life like for you as a kid?
Yeah, definitely. So grew up in Downey, California, about 30 minutes from here, down here in SoCal, and my dad was a retired chemist. So obviously was always trying hard in school, ended up going to UCLA, and started off as a pre-med student. My dad and I, we've always had an affinity for the sciences, and was kind of going through the motions, was doing well, but didn't really feel like my heart was in the right place. Started thinking about long-term prospects. Okay, I'm going to come out of school at age 32. I'm going to have like 200K of debt. Just wasn't sure it was the right decision. And so that was pretty late in the game. That was the end of sophomore year where I started thinking about that. Kind of sat down with my parents and thought, okay, what next? Or what classes did I really enjoy in the past where I might be able to switch to in terms of major? And the one that kept coming back to mind was AP Econ back in high school. And so I don't know why, I just love supply and demand charts. I get them. And I took Econ 1 kind of on a whim. Didn't take, I basically stopped taking chem, physics, and all the pre-med classes. Took Econ 1 on a whim with a couple GEs. That was the first textbook I read front to back and thoroughly loved it, Professor Sproul, UCLA. And ended up switching my major to biz econ at that point, business economics. And so then I was like, okay, well, it's late in the game. What career can I kind of stem from this major? And so started talking to some folks, got involved in the business club. Basically, the two career prospects that a lot of people talk about and that come to mind naturally are either investment banking or consulting. And so I started just cold emailing like a bunch of firms, probably 50 firms, just because I knew I had to start getting some internships on my resume. I was a pre-med student. There was no way any of these big banks were going to take me. And so I got a couple internships. I think I had like 3 out of the 50 reply and I ended up getting one, and just kept building on that. Went through the investment banking recruiting cycle, got a couple offers. One of them was Deutsche Bank in San Francisco with their TMT group. Generally, at UCLA, there weren't a ton of kids getting offers in San Francisco. A lot of the banks up there recruit from Stanford and Berkeley naturally. And also down here in LA, well, when I was graduating and during that year, which was 2013, my junior year when I was recruiting, tech and VC wasn't really big at UCLA or in LA in general.
It seems like it's really in the last year or two with the UCLA accelerator program, but they certainly are making a much bigger push now.
Yeah, that's right. That's right. And so I was kind of talking to some older guys at UCLA who had been through the process and who were starting their full-time offers in banking and said, hey, I got this offer from Deutsche Bank, their TMT tech banking group, basically. What do you guys think? And everyone's like, wow, like no one's really gotten that. Like you should go for it. And I started reading TechCrunch and getting more into it, and I was like, this does seem really cool. And so it was kind of serendipitous, and at the same time, I was a little bit scared because I'd grown up in LA my whole life, went to school in LA. I wasn't really sure if I should do it, and I was like, okay, let's do it. So 10-week summer internship, went there, enjoyed the team, enjoyed what I was doing, came back senior year, and then went full-time to DB.
What's life like? Bring us into the world working for one of the best and biggest banks. I think one of the things we're trying to get out of this podcast is especially for the college student, the freshman, sophomore, that are listening and trying right now to decide, should I be an entrepreneur? Should I be a number 2 and an operations guy? What was it like working at Deutsche Bank for those that maybe are thinking about that?
Yeah, so looking back on it, if you're going into investment banking, you know that generally it's going to be a 2-year stint or a little less. A lot of people are leaving around, the 18-month mark or so. But it's a great stepping stone because it opens up a ton of doors. So it opens up VC doors. It opens up hedge funds if you're into that, private equity. You can go to big tech. You can go to startups. I mean, just the opportunities that arise after doing investment banking are plenty. So that was why I did it, and it was definitely worth it.
What are some of the words of caution? If you kind of looking at it now from an outside perspective, what would you caution some of the newer people maybe thinking about getting into it?
Yeah, so there are pros and cons. I mean, if you have a little bit more risk appetite, then maybe banking isn't for you. It's risk averse. You're going to be making a good amount of money right out of college. If you can't handle intense, work-life balance or lack thereof, it might not be for you. To be honest, I was working a lot of nights and a lot of weekends. Actually, my first summer there, it was funny. Like summer just came and went, and I didn't actually really enjoy summer. But looking back, it was worth it because I got to work on a lot of deals, and I got that M&A and deep investment banking, both on the capital and debt side. Or equity and debt side, sorry, experience. And so that was really how I was thinking about it. Obviously now I have a lot more friends who are thinking about consulting, about startups, about a lot of different paths. And there's no right or wrong. I mean, there's pros and cons to all of it, but that was kind of how I was thinking about it. And I knew it was going to be a stepping stone. It was going to be a grind for 1.5 to 2 years, but something good was going to come out of it. And kind of transitioning a little bit, that's as VC goes, it's a pretty niche industry in the way it works in terms of recruiting, in that it's very networking heavy, et cetera. So basically, my former colleague at Deutsche Bank was good friends with someone who was working at Thomvest at the time from school, et cetera. So she kind of mentioned, hey, we're looking for an associate. Raised my hand, went through the process. I was fortunate enough to land that, but that's kind of how it works. Whereas like private equity and a lot of other industries, you get headhunters, you get cold callers, et cetera, to actually come recruit you. So VC is very network heavy in that sense.
Whereas you're saying banking is a little bit more the school you went to, the grades
yeah, it's much more structured.
When you were at Deutsche Bank, and this question applies both to Deutsche Bank and Thomvest, but specifically at Deutsche Bank, did you have a mentor, or did you have anyone that was specifically kind of helping you navigate that process of your life?
Yeah, Deutsche Bank, I had a couple, and I have a really strong mentor now at Thomvest as well, but I'll kind of bifurcate those. At Deutsche Bank, I had a couple. Sudesh Vasudevan, he's a managing director at Evercore now, at another investment bank. He was pretty critical in my development. We worked on a lot of deals together. We worked day and night on an Ancestry.com dividend recap, which that was the death of me. But great experience, great learning experience. And he was in the model, deep in the weeds. We were working late nights, early mornings, and he was critical to my development. A couple other guys, Joe Ayers, he's at Lazard now. He was super helpful in everything I was doing, a great mentor. Brad Kinish was a director there at the time. So a bunch of people were helpful, honestly.
So I think that what's really cool about venture capital in general is that not all VCs are mentors or advise startups, but many of them do offer mentorship, whether it's like whether it is paid for or given equity, or just out of the kindness of their heart for the the culture of the ecosystem. What advice do you have for other VCs that are mentors themselves? What did you learn from your good mentors that could be shared with others?
I think VC is pretty saturated now, where there are probably a lot of good mentors, and mentorship is probably just table stakes at this point. But I think being genuine, first and foremost, if you actually care about someone and care about their development, what I like to do personally is I only invest in maybe a handful of companies per year, but I look at and check out a bunch of companies per year. So even if I don't invest, like if I can have a relationship with the CEO or the founders, and if they have questions, or if it's even like up and coming UCLA students who are thinking about starting a company or thinking about getting into VC, I'll have calls with them. So any way where I can kind of give feedback and return the favor and pay it forward a little bit, I'm always happy to do so.
So, on this podcast, we have principals, we have associates, we have managing partners. For those that are on more of the associate and just getting into the game, you are someone that not just at Deutsche Bank, but also at Thomvest have been able to rise through the ranks at a very young age. What advice do you have for those that are in similar positions and maybe don't have the same natural charisma that you do?
And so are you suggesting students or young folks that are coming out of investment banking like myself, or other routes?
I would say, I think in all routes, so you find yourself at a VC fund. You're this fresh new face at a VC fund. How do you make yourself valuable, and how do you rise through the ranks without stepping on toes, without overstepping your boundary? I could imagine it was a very new place for you to be in.
Yeah, that's a great question. There are a lot of soft skills that you need to develop early on if you're going to do well here. First and foremost, you got to understand the paradigm within your specific VC firm. So what kind of culture is this? How much do partners want to take ownership over specific investments? How much of the job is sourcing versus diligence for you? I realized early on that it was going to be most beneficial to not specifically look for investments for myself, but to look for investments that were kind of in the best interest of Thomvest. And so that's where, back to your original question about mentorship, Umesh Padval, who I work with all the time, we're basically a tag team in security and cloud infrastructure. He's been a tremendous mentor, friend, partner in crime, whatever word you want to put there. But I realized early on that he was going to be a tremendous help and benefit and utility for me in VC. and it was going to serve in my best interest to work with him, not in my own interest. And so that's kind of how we formed it, and it's worked tremendously well given the exits recently and our current investments as well. Additionally, I'd say just during evenings, if you can, go to as many events as possible. A lot of people get burnt out. I got a little burnt out from networking as well in my first year or so. But it's extremely helpful because you need some sort of deal flow or pipeline coming in. And you don't know enough entrepreneurs initially to have that deal flow. But if you're going to these events where it's probably some entrepreneurs and some investors, you're meeting a lot of people at different companies, whether it's startups, VC firms, whatever. And you can use them to say, hey, like, I'll throw you this deal, which I know I'm probably not interested in given I only do security, but hey, it's e-commerce, it's Series A. I know that's your sweet spot. I'll throw that to you. And then, hey, maybe in return, you can throw me something that's more in my favor. So it's a very mutually beneficial two-way street, the VC community. And that's how I've approached it, and that's worked pretty well.
I think that's so interesting. And I think that events have a really bad rap because there is a lot of just handing out business cards and a lot of, smiles and saying hi. But I think, we right now, Coefficient Labs going to 2-3 events a week, both VC and founder specific. And the thing that I have learned the most about them is the familiar faces you tend to see. So when you first start going to a couple events, everyone is totally new. You're like, oh my gosh, I don't know who I should talk to. Right. But the more events you go to, you're like, oh, hey, Tom, hey, Billy, hey, Jared, hey, Catherine, great to see you. And then once you're at the 7, 8, 10, 12, 15, you're like, now you're actually building these relationships. And I think that, for those of you that absolutely hate networking and really, just despise it, getting over that hump and letting yourself go to 5, 6, 7, just notice the people that you're seeing week over week, because as Kareem mentioned, the world of VC, the world of startups is so relationship focused. And I always say that there's almost this unspoken, like a spit agreement or something that when you go to an event, everyone else there knows this person got off their ass, they went there on a Thursday night just like me, and it kind of puts you in on that same wavelength. So that's really interesting. You talked about events.
I agree with that. And I'll also add that the more you see these people, the more comfortable you get with them, and the more they just become your friends versus just colleagues or people in your network. And I mean, I went to Japan around Christmas/New Year's timeframe with another VC buddy who I just met a few months back, but we've become very close now, and we're surfing now, and those relationships form within a lot of those networking events where you could easily just go home and not go to those. So I think in your first 12 months after joining as an associate, that's pretty critical, and that's what I tell all the associates who join our firm too.
At Thomvest, now you guys, not that you're a traditional VC, but I think the hot item and really what founded this podcast is this idea of accelerator programs and accelerators and incubator programs like the 500 startups, like the Techstars, where there's this, kind of all of these startups that are going into these programs that are looking to take the next step. And I think that, at this level, getting VC money today, there's a lot of people writing small $20,000 checks, but I feel, and this is just a personal, it's a lot harder today to start moving into, bigger checks. What are the sorts of qualities that you look for in winning teams?
Yeah, so I'd say background is probably the number one thing. So what have you done previously? If you're a first-time entrepreneur straight out of undergrad without any experience, it's going to be tough. Just laying that out there. In security specifically, for example, if you've worked at Palo Alto Networks and McAfee and Trend Micro and you maybe have sold a company before already, that's an easier one, right? Mm-hmm. So it's a spectrum, obviously.
Let's talk about the just out of school. They don't have necessarily previous companies. What excites you, right? You meet someone, they're young. What's the sort of KPI or metrics that you're looking for that actually get you excited?
Yeah, so it's going to be the way they articulate the idea, how much I believe in the idea, and probably what I just think about the market in general. We've met companies where it's a couple co-founders straight out of undergrad with no experience, and initially you think, okay, there's no way they're going to get funded, but then when you talk to them, you're like, yeah, that's a way better business idea than the legacy incumbent that exists today. And yeah, maybe you guys won't succeed as well as maybe the 35 or 40-year-old team who's been there, done that, but maybe you can get it up and running, and we can recruit some CTO or COO or whatever, and kind of strengthen your team along the way. And so, yeah, I mean, if the idea makes sense and we're bullish on it, and we think it's following some sort of secular trend, yeah, we're probably in.
One of the things I've learned from talking to different VC funds is that some VC funds are all about the better mousetrap. Like if there's an old legacy business and you have a better solution to that problem, we'll invest. Whereas others are more like looking for the future AI. And where does Thomvest find yourselves, and who are the types of companies that are the best fit?
Yeah, I'd say we actually play on both of those levels. But that's a great question. I think a lot of VCs do bifurcate and only do one or the other. And it's basically a greenfield versus brownfield question. I think it also varies by sector. So in security, for example, it's a lot of brownfield. Like,
can you describe brownfield versus greenfield?
Oh, yeah. So greenfield is anything where players don't exist already. There isn't a legacy incumbent that you're trying to disrupt. You're actually just trying to create something brand new. So Apple's probably like the best case of that. So everything they've always tried to do is something that hasn't existed before. So they're trying to be kind of the future of what they think consumers want. In security, for example, there's like next-gen firewalls, but that's just like the next generation of something that already exists in firewalls. So I won't dive into the deep details of that, but like Symantec and a lot of those guys already exist today. And so with these newer companies, they're basically trying to claim that their tech is better and call it 10x or whatever times better, and their team is going to be able to disrupt the legacy model. And there are a lot of ways they can do that. I mean, there are a lot of trends also they can take advantage of. I mean, we're always looking at trends. So one is like, working remotely or telecommuting. So like, what's going on there? We're not investing in that, but like that's something I have an eye on just personally. So any companies doing something around that, like that's probably going to be interesting.
Which is probably like why another reason, and I'm just projecting, I don't know, another reason that you are rising through the ranks and doing so well is that you sort of have your eye on what's important, but you're also playing a little bit in some of the spaces outside of the main mix. And I think just like keeping your eye on what else is outside is an interesting thought.
Yeah, I mean, you hit the nail on the head. I do a lot of security and cloud infrastructure, but I'm not an engineer by nature. And so those first 6 months at Thomvest, when I got basically thrown into that, that was a steep learning curve. And I spent a lot of time just reading reports and research and talking to people and talking to CISOs who have done security for 10, 20 years. And I felt like, okay, I have a good grasp on it now. I'm still not an expert by any means. Maybe I'll never become an expert, but I'm good enough where I can make investments now and make bets. And so far, so good. But at the same time, I do have a lot of interest in other things. I mean, I look at health and wellness a ton and fitness, and I think that's probably a space that's going to get disrupted massively.
Being disrupted
is
for sure.
Being disrupted now, yeah. And there are waves of disruption in fitness. I mean, there's kind of like fitness 1.0 to 2.0, 3.0, 4.0, and I can go into detail on those. And 4.0 right now is basically in-home streaming. And Peloton, even though I don't use it and I probably wouldn't buy it, and I'm not a big fan of in-home streaming, the business model itself is just brilliant. I mean, $2,000 a bike plus tax. You're paying $2,200 upfront sunk cost just for a bike. Of course, you're not going to churn $40 a month for the subscription. Like, yeah, of course it's going to get to $300 million of revenue. So it's funny too, like on that point, there's a lot of groupthink where VCs won't touch a model like that for various reasons. Like it's not a software high gross margin play, which is what a lot of people want, less capital intensive, et cetera. But if you can get out of the box and get out of that groupthink a little bit and try to think, okay, where are these trends going? Like, what can be big? I think that's where you can make lucrative bets.
So what's so revolutionary? Are you saying that they, by creating a barrier of that 2,000, like the high barrier at the beginning, it almost makes it so that people aren't going to churn out of the monthly?
No, not as much that. I just think there are very niche customer segments you can target within fitness. So I mean, might as well just dive into it now.
Sure, please.
Yeah, Gym 1.0 in my mind was legacy, old school,
gym
grinded out gyms. Yeah, gym membership. So let's get a bunch of customers. Let's hope they never come, and let's just reap their whatever $40 a month subscription. Gym 2.0 was that with price differentiation. So still lackadaisical employees at the front desk. They don't know your name. It's still treadmills. It's still old school dumbbells, etc. But now we have $10 a month for Planet Fitness, target the low end. Now we got $300 a month for Equinox, target the high end. So now we're starting to see a little bit of discrimination and differentiation, which is good. Gym 3.0 was basically what I try to use a lot today, but it's still a little expensive, is Berries, Core Power, Soul Cycle. So it's these community type classes, collegial, familial vibes, energetic instructors, uplifting music, etc. So that works only until you get to Gym 4.0. And that's why Soul Cycle had to sell themselves and they got bought by Equinox and the founders made a ton of money, but they had to cancel their IPO twice because they got disrupted by Peloton. And so that's where I think that business model, back to your question, it's not that they're excluding people from coming in or anything like that. I think it's just that if you're targeting someone who's paying $2,000 right off the bat, they're not going to stop paying $40 a month. That's a drop in the bucket for them. So that's why I think that business model makes sense. And you can target price insensitive, price inelastic customers, which there obviously are a ton of, especially on the west side of LA. And you can specifically target those customer segments.
That's really interesting. I thought you were going to talk about Clasp Asset and one of the point O's, because that was a very, that's pretty unique to be able to just go in. But I think
I'll touch on them.
Sure,
Clasp Asset is basically in the 3.0 space. So they were offering Soul Cycle and Berries and Core Power all as part of their offering. But I actually have mixed feelings about them. I stopped using them because I just wasn't a big fan of the model. I think they'll do well, but if you're paying whatever $15 a month for one class, it's just not enough. Like, you want a little more. And
they changed a lot, right? Like, they started out and they eventually the model just wasn't working for them, and I think they had to kind of pivot their way out, and then it ended up affecting the user.
Agree. And then also the unit economics are tough there. So you're paying $80 a month for whatever 5 classes, but you can only use 2 on a given studio. So I can only do like 2 Berries. Where, like, for me, like, I'd rather just do 5, and that's why I would use it, because it's cheaper than actually doing 5 Berries. So there are issues with that model, but I mean, obviously they have a ton of customers, and no knock on them.
So this conversation started by talking about keeping your eye sometimes a little bit outside of what your core is, especially in VC. Let's get back to the core. So if I'm a startup, whether I'm a student and a first-time founder, or maybe I'm a later stage, but I've never heard of Thomvest, who are the types of companies that should be reaching out, should be looking out and seeing and learning more about you guys?
Yeah, so we're pretty verticalized today. We built our brand off fintech. So I mentioned some of the companies earlier. We're now doing a ton in real estate and prop tech, which is tangential. So we got a team doing both of those sectors pretty extensively. If you're doing anything in that sector, reach out to us. I obviously do a lot of security and cloud infrastructure. If you're doing anything there, reach out to us. I'm doing a pretty extensive blockchain research project right now, just started about a month ago.
What's your thoughts on blockchain? Because I feel like there is sort of the mainstream knowledge of blockchain, which is basically, it's not that it didn't exist, but it was nothing. Then all of a sudden, every one of your friends had a crypto or Ethereum, and then it sort of is taken a little bit of its hiatus. Almost, we have the VR, the HTC Vive is in our office. We haven't used it. And what's going on with Bitcoin these days, or I'm sorry, with crypto these days, and just blockchain in general?
Yeah, so I'm not an expert. I just started my research about a month ago, but my high level thoughts are. I'm pro decentralization. I think it makes a lot of sense to disintermediate a lot of those middlemen, trustees, agents, et cetera, and you can take a cut off of that cost that you're saving for consumers or buyers. I think additionally, there are a lot of companies out there claiming to do blockchain and crypto in various industries, and so there's still a lot of noise. And so, I mean, it's pretty much consensus now, but it's generally a good thing to see a correction. And that's what we saw in 2017 and to an extent still now. I mean, prices are still very depleted. So that allows kind of the hype to fade a little bit and these developers to work on their actual projects, which we like, so that hopefully in the next bull run and the next upcoming of these companies, we've kind of churned away some that probably aren't going to work. We've honed in on the better teams, and in theory, this technology actually ends up working in a few years.
Without putting you on the spot, are there any blockchain startups right now or companies that you're excited about?
So I haven't looked at a ton, to be honest. I just started looking. I mean, there's a bunch in the Bay Area that I won't name, and then given that I'm in LA this week doing the LA trip that Thomvest does annually, I looked at Everpedia. That's an awesome company. Just a little bit of background on them, just high level. I just met with them on Tuesday, but I think they're really cool. It's three co-founders out of UCLA. They're mining crypto to pay for tuition, and then came across this idea of like, okay, so Wikipedia exists, but there's no real business model. Like they don't make any actual money, and so people are adding articles and adding revisions to the articles, and someone has to approve or deny those revisions, and even the article itself initially. And I actually. So a little bit of a tangent, but what I do at Thomvest generally is three things. It's source companies that we want to invest in. It's due diligence on companies that either I or partners bring in, and then it's support portfolio companies. So one thing I was doing in supporting portfolio companies, that bucket, was I was creating a Wikipedia for one of our portfolio companies, Avalanche Technology, and it ended up getting like denied basically at the very end after 4 months of waiting, and so like. There's just something innately wrong with the Wikipedia model. Like, there's no incentive really for a lot of people to use it, to revise it, to approve or deny the revisions. What these guys are doing is basically at a high level is if you can add some sort of economic model to that, where people who are adding articles, adding revisions that are beneficial to the articles, and then also approving those revisions quickly, faster than a 4-month wait time, all three of those stakeholders can, in theory, take a divisible amount of that token and reap an economic benefit. And so that's what they're trying to do, is build a decentralized Wikipedia that adds an economic model.
And I would imagine too, somehow get like the social proof or validation that like this person was the one that made that edit, and it kind of could go in,
and it's immutable, and you have all of those transactions forever, and you can track down the person who made that random comment, or like the guy who just keeps adding one space as his revision and like trying to reap economic stake. Like you can just track that person down and like ban them. So yeah, I think that's one that I just looked at and was like, that makes a lot of sense.
Have you noticed anything, because it's really interesting. You grew up or at least are from LA or the Southern California. Yeah. Now you're living up north, which is, the mecca of all VC and all really startup culture. What's it like when you come back down to LA? We, as I'd mentioned, go to a couple events a week in the hashtag long LA and just like the overall, focus on just this industry of VC in LA. What are your thoughts on Los Angeles as an ecosystem here? And just give us your point of view.
Yeah, it's growing, that's for sure. When I was going to UCLA, there wasn't much of an ecosystem, to be honest. I don't think many of my friends, if any, even knew what VC was. And so I think that's probably an effect of a few things. But I went to school with the two Draper sons of Tim Draper. Billy's obviously at Draper Associates. Adam is the co-founder of Boost VC. And so I actually just had Adam do a fireside chat at UCLA. So just kind of getting back into the community of LA, having chats with students, things like that. I think the ecosystem is growing on a lot of levels. I think you could argue that the crypto and blockchain community here is comparable to the Bay Area version. I think Asia's doing more than both LA and SF in general, but that's a whole nother topic. But I think it's growing, and I think there are still niche areas that need to be filled. So one that I think makes a ton of sense is there's no real growth equity brand name down here. So okay, like there are a ton of angel and incubator funds and seed funds and even some Series A and early stage guys, and we know most of them, and they'll invest at seed and A, and then maybe at the B. And then if it's a company that's really taken off at C, they're kind of going to the typical brand names up in the Bay Area for that late stage funding. I kind of wish there was just a big brand name in LA that could do that, where they don't need to go up to the Bay and do that. So that would help the LA ecosystem if some sort of growth brand name could exist. But it's not easy. It's not easy.
Mm-hmm. That's really interesting. Yeah, they were talking about that at, I believe it was Quaker Backstage's event last week or a couple days ago, just around the ecosystem of getting more Snapchats, getting more Pinterest, getting more of these companies. We need more investors like you're talking about that are a little on the later stage. Cool. Well, Kareem, this was an amazing podcast, and I really appreciate you jumping on with us. Where can people find you, whether it's startups or VCs or anyone that wants to get to know you guys better? Where should they go to turn?
Yeah, Thomvest.com, Kareem at Thomvest, my LinkedIn. You guys can find me.
Okay, great. Thanks a lot, Kareem. We really appreciate you, man.
Yeah, thanks so much.
Thank you guys. From all of us at Demo Day, thank you so much for tuning in. Much love. Peace.
Generally, investors don't like that. You could do it, but I would advise not to. One person needs to be leading the vision and execution of all this.